Okay, ladies and gentlemen, let's run through some transactions for the equity section, shareholders equity, and let's take a look at the first one. Take a second to read the question and I'll come back to you in a minute or so, okay? Okay, so we have two classes of stock, common and preferred. And the common is $7 par value for the common and $12 par value for the preferred. So we want to issue that stock. Let's say it's a new corporation and so forth. So we're going to journalize both of these transactions. 2,000 shares of common stock for $40 a share. Okay. Take a minute and run the numbers for 2,000 common at 40 and 2,000 preferred. Well, you don't have to run this number. It's 106. Okay, so 2,000 common is $80,000. Okay, so take a minute and rough out, at least in draft form, what you think the entry is, the journal entry for 2,000 shares of common at 40, remembering that we only record the par value amount, which is $7 in the common stock account, and everything else is in additional paid-in capital. Here's our entry for the common. The total proceeds from this were $80,000. We have par value of $7 per share, so 2,000 shares times $7 par value is equal to 14,000. And the APIC is a squeeze for everything else. So debit cash 80,000, credit common stock for just the par value portion, and the APIC is a squeeze for everything else, 64,000. Now let's do the same thing for preferred. The process is the same, so I want you to take a minute and rough out the entry. Okay, so here's our entry for preferred. The total proceeds were 106,000. The preferred stock is 2,000 shares times a $12 par value, or 24,000, that goes in the preferred stock account, and everything else, 82,000, which squeeze, goes into APIC preferred. Now notice I wrote APIC preferred, and then I went back and adjusted APIC common. So if we have two classes of stock, we identify the capital paid in excess of par for common and preferred accordingly. Okay? Compare your answer, make adjustments. Let's just learn it the correct way, and we're going to move on now. Okay, our question on dividends. Take a minute and read this question. Put it on pause, read the question, and then come back to me and we'll break it down. Okay, so we want to analyze this dividend situation here. The company earned net income of 90. On December 15th, it declared an annual cash dividend on its 6% preferred and an 80 cents per share dividend on common. So take a minute and rough out what you think that dividend would look like. I'll come back. Okay, here are the calculations on the dividend. So preferred is 115,000 par value, 7%, that's 8,050. And for the common, 80 cents a share, 70,000 shares outstanding, 56,000 on a combined basis, 64,050. So the entry here would be a debit to either retained earnings or dividends payable, depending on what choices you're given, of 64,050. And credit to dividend payable of 64,050, and then the payment of the dividend would be a debit to dividend payable 64,050, reversing this entry, and and a credit to cash. And that's it for that question. We'll move on. Let's take a look at this question on dividends, common and preferred. Here we have a capital structure here. So the preferred dividend is 1%, $110 par value. So what is that? $1, basically $1 per share. 900 shares. $1.10, I should say. $1.10 a share times 900 shares. 99,000. So my par value is 99,000. So the question is, let's review the scenario under dividends for preferred and common. So the question asks, what is the formula that we need to determine the amount for the preferred dividend? $99,000 in the par value designation for preferred, 99,000, 110 par value, 900 shares, 99,000. We pay 1% dividend each year for that. So 1% of 99,000 is $990. That's the preferred dividend. And basically, as it indicates here, that's the amount of dividend that must be paid before common can start receiving dividends, because the assumption is cumulative. So there's a catch-up provision. So suppose the company declares a total cash dividend of $45,000 for both classes of stock. The first $990 goes to preferred. Once they're paid, the balance goes to common. So the assumption is that preferred is cumulative because it's not designated as non-cumulative. So under the case that the company passes the dividend for 2016, 2017, and has money for 2018, those 3 years, 2016, 17, get caught up plus the 2018 preferred dividend. That combined amount is $29.70, and the common dividend gets the balance if we had an $18,000 cash dividend. So that's one of the uniquenesses of preferred, especially the cumulative preferred. Just be aware of that. It's a good concept to know.